Hello, I'm a 21-year-old investor looking to compound my wealth in the stock market. So in today's episode, we'll be covering mainly two different portions. In the first part, I'll be covering this article here. It's about moats that you might have missed. And then in the second portion, I'll be covering some stocks that I view as attractive in today's market. So let's take a look at this article over here. It's on the moats that you might have missed. This is on our Substack. Feel free to check it out, link in the description box below. So over here it says, a moat is defined as a company's ability to fend off competitors and maintain its durable market share for a sustained period of time. Because competition is for losers. So if you're in an industry whereby there's a lot of competition, like for example, your airlines business, your cybersecurity business, it's hard for a company to maintain its competitive advantage because it will eventually be eaten up by another company that is in the space that is probably more innovative as well. So over here it says the more competitors you have, the more you have to split up the market share of an industry and the less money a company makes. So most investors are accustomed to the mainstream moats, like for example, your barriers to entry or scale, network effects, but there are some moats that a lot of investors miss. So we'll be covering this portion in this article here. So first one is something called cost advantage. So cost advantage is a significant moat as well. It's the ability for a company to maintain low costs for a sustained period of time relative to its competitors. So this is normally for your commodity companies. So for example, a company that I hold is Warrior Met Co. This was an investment thesis that we shared on our Substack account. And for Warrior Met Co, one of the moats for the company is the ability for the company to produce its coal at a much lower price relative to its competitors. So when a company is able to do it this way, then what happens is during a cyclical downturn, all the other companies in the space, they will start losing money because the cost of production is actually now higher than the cost that they're selling at. But for Warrior Met Co, because of its ability to maintain low cost, what that will mean is even during this cyclical downturn, when other companies are suffering, Warrior Met Co will still be able to maintain profitability. And this actually helps to reduce competition from other companies because those companies might become bankrupt and Warrior Met Co might be able to buy them over. So when you're trying to invest in cyclical companies, in commodity-based companies, look out for those that are able to maintain low cost. Okay, we'll continue with this article. So besides cost advantages, the second moat that a lot of investors miss today is something called a bundling moat. So a bundling moat is what Chris Hohn said in his recent interview, is the ability for a company to maintain its competitive edge by bundling all its products together and selling it as one package. So over here it says, think of Microsoft 365 subscription with everything bundled together, Teams, Copilot, PowerPoint, Excel, and so on. There was an example that Chris Hohn brought up, which was that Teams and Zoom are in competition. Zoom probably has the better interface, but Teams is actually sufficient for most enterprises. And because all of the enterprises, they already have a Microsoft 365 subscription, they will just use Teams rather than spend extra money to subscribe to Zoom as well. This is a rare occurrence for many different software companies. Think Adobe, think Microsoft. And I think apart from that, it's hard to find a company that has the ability to do it this way also. Besides bundling moat, we have other forms of moat as well that is neglected. The next one is a physical asset moat. So a physical asset moat is another one that is frequently neglected by investors. Cell towers, your regional shopping centers, your airports are great examples of physical assets that provide a moat for the company. So when an airport is already built in a space, there is really no reason for another competitor to come into the space because it's sort of like a geographical monopoly. And the capex to build up all these different airports as well as your shopping centers is extremely intensive, and this provides high barriers to entry for all these different companies also. So think about Singaporean companies like, for example, your CICT, Fraser Centrepoint Trust. All these companies, although they're not the fastest growing, they're companies that are able to bring in expectable and predictable free cash flow every single year. Same for companies like Aena. This is an airport company that Chris Hohn owns. Same for another company like your cell towers, like American Towers. All these companies are predictable businesses, quality predictable businesses that the markets are actually neglecting today. Next portion, another type of moat that is neglected today is one that is a meaningful moat is regulatory moat. So the reason why FICO is so successful in its credit scores is because of regulations. So back in the day, FICO was the only score that was permitted to be used by your government-sponsored enterprises. So what that means is, in order for a government-sponsored enterprise to buy over the mortgage, you will have to use and provide them with a FICO score. So a lot of your different mortgage companies, what they did was they standardized the process. They used only FICO score and no other scores, which is why FICO is such a strong company today. So regulations can be a boon and a bane. When a company is written in regulation, like FICO for example, like your Vantage score, then what that means is the company will have sort of like a high barriers to entry also. It's a very strong advantage, and as long as the company doesn't exploit it, it will maintain its market share for a very long time also. Next mode is patents as well as IP. So patents and IP is a weaker form of mode. Patents, I would say, is the weaker one because patents are more commonly associated with your pharmaceutical companies. IP is more associated with your software companies. Like for example, ASML has significant moats in terms of its IP. Synopsys, some of your other semiconductor companies also, they have very significant IP. They're very significant IP, and it is hard for another company to replicate what they're already doing. So for example, over here it says Disney has a very strong IP. It has many different characters here. So every year, they license out their characters, they license out their shows. Disney would have been a great investment if it wasn't for the management. Same thing for Eli Lilly as well as Novo Nordisk. These two companies have been able to tap on this weight loss drug industry, and they've been very successful in doing so because they were the first companies to come up with the IP for this industry. We'll go a bit deeper now. So there's a second part to this article over here. It's a deeper level analysis of moats. So a company's ability to maintain its moat, to protect its moat, is commonly measured by something called ROIC, which is your return on invested capital. That's why it's so important for you to look out for the company's ROIC, because ROIC can be broken up into two parts. Your ROIC is normally your NOPAT, which is net operating profit after taxes, divided by your invested capital, but you can actually split it up into two different parts. One part is NOPAT divided by sales. The other part is your sales divided by your invested capital. So NOPAT divided by your sales is actually measuring the margins of the company. Sales divided by invested capital measures the turnover rate, the frequency of them selling their products, basically the quantity that they're selling at. So over here it says NOPAT divided by sales measures the company's margin. If a company is able to maintain its high margins, then what will happen is this portion of ROIC will be high, pushing up the ROIC. And then the other portion is your turnover. So turnover is the company's ability to sell a higher quantity of products. So a lot of your different small companies, they have artificially high ROIC because they sell a high quantity of products. That is normally not the optimal way for you to maintain a high ROIC. Normally, the best way to maintain a high ROIC is through higher margins, through differentiated products. Besides that, a lot of investors neglect one more thing, which is something called willingness to pay. So we'll cover this one in the portion below. So high barriers to entry can be broken up into a few parts. You have economies of scale, capital requirements, benefits of scale, consumer switching costs, as well as this restrictive government policy, which we covered earlier. So economies of scale is when a company is able to lower its cost per unit as the output increases. Demand side benefits are commonly associated with network effects. This is another barrier to entry for a company. Customer switching cost is also another one that's important. And then another thing to take note as well is a company's ability to increase prices, which is the pricing power. So a lot of investors today, they talk about pricing power, but beyond pricing power, there's actually one more element to it, which is the company's ability to increase the perceived value of their products. So when a company is able to do so, if they're able to justify the price increases, then what happens is the supply of consumers will still remain the same. So over here it says to bring it up a notch, there's more nuance to this, which is to measure the customer's willingness to pay, which is the WTP. When a product is able to increase its perceived value, including new features and increasing the customer's willingness to pay more for the product, pricing power naturally comes without resistance. So a few companies able to do so. Some companies include ASML, Microsoft, Google with their increased return on ad spend, Meta, Apple as well. So when a company is unable to increase the customer's willingness to pay and they increase the prices, then what you will be met with is customer satisfaction dropping over time. So for example, a company that has been doing this very strongly is FICO. So FICO has been increasing prices over time, but the willingness to pay by its consumers is still around the same level. I mean, it's a score, so it's very hard for them to increase the perceived value of the score, but they've been aggressively increasing prices. This is not sustainable for a very long time. Of course, companies with pricing powers are still considered quality businesses, but if you're able to find a company that has both increasing levels of willingness to pay as well as increased pricing power, then you really have a strong compounding machine there. That includes companies like ASML, like Microsoft, like Google, like Meta, as well as Apple. Okay, next portion, I'll be covering some companies that are looking interesting today that I'm possibly looking to add into. So the first one is Microsoft. Microsoft is currently trading at a 33 times of earnings. So they actually realized an open AI loss in their net income statement this year in the last quarter. So if you're to remove that portion, the company is currently trading at around a 32 times of earnings. So it's actually around its median over the past few years. And for Microsoft today, just to put into perspective the valuation of the company, so assuming a 28 times earnings for this company and assuming a 14% EPS growth over the next 5 years, at its current stock price of around $470 a share, the company will give you around an 11% CAGR. So my thought process behind Microsoft is this. I'm actually looking at possibly rotating some of my Google holdings into Microsoft. So Google is currently now at around 13% of my entire portfolio. I think Google's valuation today is very high. So if you're to look at Google, for example, I believe it's currently trading at a 31 times of earnings. And if you're to remove the portion, which is the company's investment gains, the company is currently trading closer to around a 35 to 40 times of earnings. So it's on an elevated level, although it's one of the AI winners today. I agree with the notion that you shouldn't be trimming companies that are AI winners, but there's also another perspective to it, which is to try and protect your downside risk. And I think for Google at its current valuation, it is pricing in a lot. A lot of momentum is pushing up the stock price today. So I might look to trim my position when the upside is no longer there for Google, trim it and rotate it to Microsoft when it's trading at a more reasonable valuation. I view Microsoft as the more durable company in the long run. The next company that is looking interesting today is Mercado Libre. So this is Mercado Libre stock, currently trading at a 48 times of earnings. And over the past few years, this is actually one of its lowest trading multiple. So for Mercado Libre, it's a company that is growing rapidly. So EPS has grown at a CAGR of around 35%. Revenue, I believe, is also growing at the same rate. So they're actually growing revenues at around 30%. In fact, it's 48% over the past few years. So it's a company that is still in a relatively fast growth phase. And for Mercado Libre, their profit margins are actually suppressed right now because the company is trying to expand as much as possible. It's similar to what Amazon did in its early days. Try and gain as much market share as possible, try and increase the revenue, and then move towards profitability in the future when the company becomes a bit more mature. So for Mercado Libre, the problem that I have with the business is the inability for me to assess the company's credit worthiness. So apart from them having a BBB plus based on Moody's, it's almost impossible for you to assess the credit quality of the company apart from the metrics that they post out. So for example, their 9-mile, their non-performing loan metrics, and so on. But it's very hard for you to assess that. So for Mercado Libre, I think it's a company that is quite attractive. It's interesting. It's growing very, very fast. It's having a P ratio that is currently suppressed. And if it were to push towards profitability, I think the P ratio will be a lot lower than what it is today. And another thing to take note as well for Mercado Libre investors is that Mercado Libre is trying to push for more of an Amazon FBA model. So what they're doing is they're trying to build out all these different distribution centers in Latin America. But the problem with that is this. For Mercado Libre, their average order value is a lot higher than other companies like Shopee in Latin America. So what that means is Shopee has a much higher turnover rate, whereas for Mercado Libre, they have a much lower turnover rate. So their FBA model isn't fully optimized. So they'll have to push downstream to try and capture more of the lower end products, which I'm not sure if the management is doing today. I've been looking at it though. If it ever comes a time where I can understand the company's ability to protect its books, then it might be a company that is worthy of an investment today. I hope you guys have found this video useful. Feel free to check out our Substack and invest safe.